So traditionally, we are taught in the financial world that we purchase, let's take, for example, a vehicle. If we're purchasing a vehicle, we're taught one of two ways. Um, Typically, we either pay cash, we save up and pay cash, or we take a loan and borrow from a bank, and then make payments on that. So what I'm going to do is I'm going to draw an illustration to show those two ways and actually show a third way when we use the infinite banking concept. So first of all, I'm going to draw a line, and I'm going to call this my zero cash line. And so above that line is going to be positive, and below that line is going to be negative. Now, let's pretend that we're going to take a loan to purchase this car. And so immediately we go in the hole. And then we start making payments to work our way back up to zero. And then, by that time we either need to replace that vehicle or get our wife a vehicle or our child or so forth. So then we take another loan, which takes us in the hole again, and we start working our way back up to zero through making car payments. Now, the bank loves this because they are earning all the interest. In fact, when you take into consideration all the financing that the average American does over their lifetime, they're going to lose $600,000 just to interest. Said another way, that is 34.5% of after-tax dollars that goes to interest. Okay, so that is staggering, especially over a lifetime. So borrowing from a bank and paying for vehicles that way is not going to get us ahead for sure. So now what we're going to do is we're going to look at what we did as a family, and that is we're going to save up. And once we have enough cash, we're going to then pay cash for that vehicle. So you'll see as I'm drawing this picture that we're saving, and once we have enough to pay cash for that vehicle, we go pay cash for it. And you can imagine all the interest that we're saving by doing that. But I want to point out something. At this point right here, how much compounding interest is happening on those dollars that we just used to pay cash for that vehicle? Zero. What we're doing is we are interrupting the compounding interest on those dollars. And then we start the whole process again. We start saving, and we get up to the point where we can pay cash for that next vehicle, and we go pay cash, and we interrupt that compounding interest again. And we do that time and time again over the course of our lifetime. So what we want to introduce to you is a third option. And this is how infinite banking comes into play. What we're going to do is we're going to use a dividend paying whole life insurance policy almost as our savings account. Okay. And instead of putting that cash into a bank or in a savings account, we're going to deposit that money into our whole life insurance policy. Now, these policies are designed a little bit differently. Typical life insurance policies are designed for death benefit. They emphasize the death benefit. But the way we design these policies, according to Nelson Nash's teachings, is we're going to design these to emphasize the cash value, the banking function of this, okay, the financing function. And so we're going to deposit our dollars into our dividend paying whole life insurance policy. And then we're actually able to take loans against that policy using our policy as collateral and then go pay cash for the vehicle. However, the compounding interest, which is guaranteed, does not stop, even though we have taken a loan against our policy. Now, what I want to do is show you why is that possible, okay? And so what I'm going to do is right here, I'm going to show you we have our IBC Infinite Banking Concept life insurance policy. Okay. And I'm going to draw a little picture of, let's just say this is me or you, and you're ready to purchase a car and you've been capitalizing or making deposits into your policy. And you say, hey, I've got enough in there. I now want to go pay cash for this vehicle. You're going to take what is called a policy loan. Now, that term makes it sound like it actually comes from the policy, but that's actually not true. Policy loan is actually a really poor name for it. What actually happens is over here on this side, we have what is called, well, let's just say this is the pool of money that the life insurance company, and we only work with mutual companies. That means the policy owner is an owner in the company. Okay? So the mutual life insurance company has a really large pool of capital. And when we say we want to take a policy loan, what's actually happening is we're taking a loan from this little orange slice from the capital of the company, and they're using our IBC policy as collateral. So they actually are guaranteeing that they will receive that money back at the time that the death benefit is paid out. But in the meantime, they actually don't care if you make payments on that loan. And what that does is it gives us, as the policy owner, complete control of the financing function. It's really phenomenal. So the life insurance company is making a loan to us that we can use to go pay cash for that vehicle. Okay, we're using our policy as collateral. It continues to grow and compound because it is not impacted by the loan. Then we get to set up the terms of making that payment, that car payment, back into our system, which is actually back to the company, but by contract, we have first rights to that money, which is really phenomenal. So now we're making payments back to the company. If we're really smart, we'll apply EVA and we'll actually make those payments back to us at least the same rate that we would have borrowed from a bank or some other financial institution. So EVA is economic value added, and we're going to charge ourselves for the use of our own money. Now, if we charge ourselves even a little bit more, the beautiful thing is we increase that orange slice and we can come back and borrow even more. And so we want this process, we call it flow. We want this process to flow as rapidly as possible, charge ourselves for the use of our own money using economic value added, and just keep that cycle flowing the entire time. Now, here's the amazing thing. Let's just say, hypothetically, that the policy owner, in this case is me, let's say that the policy owner passes away. At that point, the life insurance company will subtract the loan amount from the death benefit. So I'm going to give a real life example. I have $1.2 million in life insurance coverage. We have borrowed from the company $200,000 in policy loans. So if I pass away, they will take the 1.2 million minus the $200,000, which leaves $1 million that will go to the beneficiary, which happens to be my wife. Now you might ask, okay, so you're borrowing money from the mutual company. Are they just giving that to you for free? No, there is an interest rate, and we want to talk about that. They're going to charge 4.76% on that loan. That is one time upfront when the loan is taken. Why are they charging us 4.76? Here's the reason why. This money in the orange slice, if we did not borrow it, the company would be investing those dollars for two primary reasons. One is they've got to grow that money because by contract, they're going to pay a death benefit at the insured's passing. Secondly, they are growing that money to pay dividends, which is what's paid when the company makes money. They pay dividends to the policy owners. If we take this orange slice out of that flow and we are utilizing it and they cannot invest it, they've got to somehow make up that difference. So they charge us 4.76 on that policy loan. Now, really, that 4.76, what it's doing is it's making up the difference for those investments, which are going towards our death benefit. Okay, who benefits from that? My family, my beneficiary, and the dividends. Who benefits from that? I do. So you can see in this case, the 4.76 is actually beneficial to me and my family. Now, I want to take it a step further, and this is really amazing. When I start making payments back to the company on that policy loan, they actually start crediting back to me the interest that they charged. Isn't that phenomenal? So now, as I'm making those payments back to the company, they're crediting me back the interest that they charged. So let's just say that they charged me $100 in interest on that policy loan, and I didn't make any payments back to the company for 6 months. But at the half year mark, I paid back the entire policy loan. They're going to credit me back half of the interest they charged me because I had that money out for half the year. So they're going to credit back to me $50 of that interest that they charged us up front at the beginning of the policy loan. Pretty amazing deal that Nelson Nash figured out by utilizing whole life insurance, especially when it's designed to emphasize the cash value versus the death benefit. And we can utilize this as a banking tool. As Nelson says, whole life insurance is really misnamed. It's really an unbelievable banking tool that just happens to have a death benefit attached to it.